This is task 6 from the first sample assessment for personal tax. So task 6 tests tax planning. So if you look at part 1, in 24-25, Miss Z's sole income is $52,500 from employment, and she wants to make pension payments from the start of the tax year. So Miss Z wants to know if paying £200 per month into a private pension would result in a lower tax liability compared with paying £200 into an occupational pension scheme, which would be deducted from the employer from the gross salary. So let's compare the two. Let's look at the occupational pension scheme first. So remember, we've got our income of $52,500, but if we pay into the occupational pension scheme, then that £200, and remember we're going to pay that for 12 months, so that becomes $2,400. So that $2,400 would be deducted from our salary by the employer, and therefore our remaining income that would be taxed is $50,100. Now of that income, remember we've got our personal allowance, so we would deduct the $12,570, leaving us with $37,530. And we can see that's going to be inside the basic rate band, because remember our basic rate band is 37,700. So all of that would be taxed at the basic rate of 20%. So we would pay tax of $7,506 if we paid into the occupational pension scheme. So what if we paid into our private pension? Well, we do this from our net pay. So we would still have our income of $52,500, but we wouldn't have any deductions from the employer. So from that, we would take off our personal allowance of $12,570, leaving us with $39,930 of taxable income. Now we can see that some of that could go outside the basic rate band, couldn't it? But remember, because we're paying into a private pension scheme, we can increase our basic rate band. So that $2,400, remember, that is the net amount. So what we need to do is multiply by 100 over 80 to find out what the gross amount was. So 2,400 divided by 80 multiplied by 100 would give us 3,000. So that's the gross figure. So our basic rate band now changes. So our basic rate band goes from 3,770, and then we increase it by that 3,000. So our basic rate band now becomes 4,700. So that tells us then that our income of 39,930 is still within the new expanded basic rate band, so we will still pay tax at 20%. And giving a tax payable of 7,986. So we can see that if we allow our employers to deduct £200 a month, we will pay less tax than if we pay that money into a private scheme from our net pay. So the difference between the two is £480. So the question tells us, you tell Miss Z that if she selects a private pension scheme, her tax liability will be £480 more than if she selects to pay into an occupational pension scheme. So notice what's going on here. The government wants us to pay money into pension schemes to prepare for our retirement, and there are tax benefits for doing that. So if we use an occupational pension scheme, that's deducted from our income, so we pay less tax. But if we pay into a private scheme, the gross amount is added to the basic rate band. And you see what happened there, because when we first looked at the 39,930, that's greater than the 37,700 in the basic rate band. So some of it may have been taxed at 40%. But by adding the gross amount to the basic rate band, it means that all of our income is taxed at the basic rate. So we pay less tax by paying into a private pension scheme. But overall, though, in this particular case, it would still be better to use the occupational pension scheme. Let's look at the second issue now. So Miss Q, a higher rate taxpayer, and that's going to be significant for us here, was provided with a company car for the whole of 24-25. So it's the whole of the year, so we don't need to do any time apportioning. The cost of the car used in the benefit in kind computation was 36,200. Remember, that's going to be the list price. And the taxable benefit in kind for 24-25 is 7,964. So if we know what the taxable benefit in kind is, and we know what the list price is, we could just go backwards, couldn't we, and work out what the scale rate is. So we can just see by looking at these two numbers that the scale charge must have been 22%. So the diesel engine of the car does not meet the RDE2 standards. So because it does not meet the standards, well, what impact is that going to have on the scale charge? Well, let's have a look at the reference materials. So here's section 7 of the reference materials, and it tells us that if we meet these clean engine standards, then we do not need to apply the additional 4%. So in this particular question, they do not meet the standards, and therefore this diesel engine, a dirty engine, incurs a higher tax rate. So there's an extra 4%. So of the 22%, 4% of that is because of the dirty diesel engine. So the underlying scale charge is 18%. So Miss Q wants to know how much tax she would have saved if she had been provided with a car with a petrol engine instead of a diesel engine, assuming all other details remain the same. So how much tax would she have saved? So if she had a petrol engine, she wouldn't have to incur this 4% extra. So that means that her car, remember, has got a list price of 36,200. Yep. We would save 4% on the scale charge. But then how much tax would we save? Remember, we're a higher rate taxpayer. So we would pay tax at 40% on that. So we've got our 36,200. The savings in the scale charge is 4%, and then we pay 40% tax on that. So that means that we would save £579. Now notice this question asked about how much tax she would have saved and not how much benefit would go down. So you read carefully what the question's asking for. Lots of people make mistakes that it may say ask what's the tax saving, and people may work out what is the reduction in the benefit. So the reduction in the benefit would have been that number, but because it was asking for the tax saving, you need to multiply by the tax rate. Let's have a look at part 3 now. Mr. X is a higher rate taxpayer and has inherited £50,000. He currently has no investment income and he wants to invest the money in the most tax efficient way. Mr. X has looked into different investment options. He decided that he does not want to invest in shares. So that tells us that we shouldn't talk about shares in our answer, should we? So Mr. X wants to know how much tax he will pay if he decides to invest all the money with his local building society in the most tax efficient way. All investments with building society make an annual return of 2%. Okay. So he wants to do this in the most tax efficient way, and that means of the 50,000 that he's inherited, then he should use an ISA, an individual savings account, because that is tax-free. Section 4 of the reference material tells us that there's an annual limit of 20,000. If you put more than that into the ISA, then you will have to pay tax. So of the 50,000, 20,000 should be put into ISA, and that will have no tax to pay. And then the remaining 30,000 would be invested, and we would earn a return of 2% on that. So the 30,000 multiplied by 2% means that we would earn 600 in income, and then that will be taxed at the higher rate of 40%. But remember, of that 600, there would be an allowance which would be tax-free. So again, let's have a look at the reference materials first before we do the calculation. Here's section 2. And remember, we have a higher rate taxpayer, and there's a £500 allowance before we start having to pay any tax. So of that £600, £500 would be covered by the allowance, so there's no tax to pay on that. And then there's the remaining £100, which would incur tax at the 40%. So overall, there would be £40 of tax to pay. And let's have a look at the last part now. So Mrs. B has been offered a loan from her employer of £12,000. This is the only loan she has had from her employer. The terms of the loan are that she does not need to pay the loan back for 5 years, and she needs to pay no interest. So Mrs. B is worried that this loan will have tax implications. So you tell her that if she pays interest of at least something percent, she will pay no tax. So section 12 of the reference materials gives us the HMRC official rate of 2.25%. So if she pays at least 2.25% interest on this loan, then there will be no taxable benefit.